All right, hello and welcome to today's In Conversation with Dr. Sherry Cooper, sponsored by FCT. I'm your host, Eddie Cocciollo, president of Dominion Lending Centers, Inc. Dominion Lending is made up of over 3,000 mortgage professionals right across the country with access to Canada's best mortgage rates. Whether you are buying your first home, refinancing, self-employed, moving on up, or downsizing, with access to hundreds of financing options, we can find the right fit for you. If you are not using a DLC mortgage expert for your home financing needs, you're probably paying too much. Visit dominionlending.ca today and find a mortgage expert near you. Dr. Sherry Cooper is Dominion Lending Center Chief Economist. She is a sought-after speaker, writer, and advisor renowned for her ability to simplify and demystify the complex subjects of economics and finance. Sherry is the author of 3 best-selling books, The Cooper File, Ride the Wave, and The New Retirement. Also, on dominionlending.ca, click on Economic Insights for Sherry's very insightful article on the latest economic trends. Hey, Sherry, how are you?
I'm great. Thanks, Eddie. How are you?
I'm good. You know, it's funny. You must be like a kid in the candy store, because as an economist with everything going on, you must be constantly just looking at everything that's happening, all the trends, and it must be just fun for you. Is it fun for you?
Yeah, I mean, it's always interesting. You know, there's always something new going on. But in this difficult time, everybody's worried about what's next, what's going to happen with the economy, what's going to happen with housing markets. And this period has been very surprising in many ways. If I had told you in last March, when the pandemic began, that we would actually see record rebound in housing and very strong housing markets, you wouldn't have believed me. So,
and that's so true. I mean, we were preparing for, the worst, and that's what, good companies do. And yeah, what a shock when it came to housing in our industry. But we'll get into that in a minute. It is December, so the last month of the year. So it's amazing how quickly this year has gone by. Has it gone by quickly for you as well?
In some respects, it's flashed by. In other respects, it seems like I've been stuck in this condo for a million years.
Yeah, and we'll talk about how much longer we'll feel like we're stuck. But let's start with GDP, because there's a lot of news around that. Big time retraction in the second quarter and a big rebound in the third quarter. Can you tell us a little bit what you're seeing and why such a big discrepancy between the two quarters?
Well, of course, the March lockdowns just told the tale of what was going to happen in the second quarter. And we knew we would see a record decline in the economy, just as every other country in the world has suffered the same. And as well, we knew that there would be a substantial rebound in the third quarter, particularly as the weather warmed, the number of COVID cases went down, we flattened the curve, we began to open up the economy all across the country. And keep in mind, though, that when you see something decline by 50%, like take an example, if a stock price declines from 100 to 50, okay, it's declined by 50%. If it goes up by 50% in the next quarter, it's still only at 75.
Right.
See, so the economy did, we had a record rebound in the third quarter, but here we are back in the second wave. And that's what's absolutely driving economic activity and consumer sentiment, business sentiment, and all of the policy concerns is Canada has really suffered during this second wave. So has everybody else in the world, for that matter. But we see that right now, the average number of new cases per day is running above 6,000, which is well above the peak back in last May. So the governments at the provincial and federal levels have decided that in many parts of the country that we would return to a targeted lockdown. It feels pretty much like a total lockdown, frankly, at least where I am in the city of Toronto and many other parts of the country. But it's very difficult. It hits especially those sectors that have already suffered so much, those sectors where people cannot work from home, those sectors that typically require face-to-face contact. Those would be anything to do with food services, restaurants, accommodation, most leisure activities, very hard hit. Retail also, and especially this time when non-essential retail is shut tight. And we're in the Christmas season. Yeah. So, people can buy online. And I was just looking earlier today at how many restaurants are providing takeout now and delivering holiday meals and all of that. But that's great. It's innovative and it will help, but it's not the same. And so we're going to see considerably slower growth in the current quarter.
Yeah, and lots of talk about the vaccine. That's the big news item. And Canada just approved one, and I hear they're close to approving another, and that is good news, because if there is a bottom, it's because of the vaccine. If there is an end, it's because of the vaccine. And you can see them, stock markets are looking at that future, and most people are saying, hey, you know what, it's about time, and how do I get my vaccine fast enough so I can start enjoying my life a little bit more. So is that news positive news? You said that there's cases increasing more and more. We know that we're going to go into a bit of a challenge still, even though the vaccines are announced, doesn't mean you got them yet. So there's still going to be some challenges. Where do you see all of that playing out?
Well, the first announcements about a month and a half ago by Pfizer and then Moderna showing the efficacy of the vaccine led to a super rally in stock markets around the world. As well, it did lead to higher interest rates. Market interest rates did rise. Now, that it's real in the UK. They're already vaccinating. My understanding from hearing what the Prime Minister in Canada is saying is they will begin to vaccinate next week in Canada. But the truth of the matter is that according to Ottawa, the bulk of the population will not receive the vaccine until roughly September of 2021. So that's 3/4 of the way through 2021. And there'll be hiccups along the way. There always are. And it does take two shots before, and a week after the second shot before your immunity peaks. And there's still not a vaccine for children or even people under the age of 16. There's still big question marks about whether pregnant women or nursing women should have it. And as well, there have been a couple of cases of anaphylactic shock from the vaccine in the UK. So now they're saying if you have serious allergies, you probably shouldn't take it. But it is great news. I don't know where it's going to be offered. A lot of details have to be hammered out, but it is the reason that that the Bank of Canada is still providing significant monetary support to keep the lid on interest rates.
Yeah. Let's talk about that, because they continue on giving money to where money is needed, but you look at the debt that's being created, and you have to admit it's shockingly huge. It's not anything that anybody has said or seen before. So you're looking at that debt, and you're looking at the governments keep spending money, and you can't help in the back of your mind thinking, how are we going to pay for this? How are we going to help get us out of this deficit? We know that you said September, so we're going to keep supporting the economy with more and more stimulus, and it's going to just get bigger and bigger. Is there what is your take on how are we going to pay for this eventually? Well, first of all, tell us about why it's important for the government to be doing this, but then how is it that we're going to pay for it?
Well, last week we did see the release of the budget update, and it was a very aggressive actions. The actions, we don't have all the details, but it increases the deficit to 381 odd billion, and it could well be up to 400 billion in the next year. The government has said that they will provide support to businesses, support to particular sectors, travel industry, restaurants, those that have been hardest hit, that there will be continued income support especially for those who have lost their jobs. But they're broadening it to as well, establishing a national daycare program, providing support to schools so that they're able to maintain the level of safety, proper ventilation, etc. So big numbers, about $100 billion of new spending. And as a result, as my chart shows, the budget deficits are going to be very, very large. We got to go back one more. Not that chart, the one.
I think it's titled, Dave, it's titled Deep Deficits. Yeah.
Yeah, deep deficits.
There you go.
Thank you. The budget deficits are just out of sight, the largest since World War II. The good news is that Canada began the pandemic period with very low debt to GDP ratios. In fact, the debt was only 31% of GDP. At this stage, it looks like the debt is going to get up to about 50+% of GDP. Canada has had the largest fiscal stimulus program in the industrialized world. Now, there is concern about that, because what is going to be important is how we finesse eliminating over time the programs that are meant to be temporary, and also to avoid supporting businesses and sectors that aren't going to make it anyway. So you want to do everything you can to cushion the blow for everyone, but you want to encourage and support the growth sectors of the future, as opposed to keeping alive a lot of businesses that may well have been tipping over anyway.
Right.
So we will gradually dismantle many of the support measures, but the timing and how that's handled is tricky. And that's why, again, the Bank of Canada has said that they would support the economy through low interest rates and quantitative easing. Now, the overnight rate in this past meeting was held steady, just as it has been since really the early part of the pandemic. Overnight rate is at just 25 basis points. It's exactly what the Bank of Canada calls their effective lower bound. They don't want to see the interest rates falling into negative territory. And so as a result, they will maintain that. And I do have a chart of that somewhere, Dave, that you haven't put up yet.
So
the one before that.
Holding low, I think it's called holding low. So as Dave, that's the one.
That's it. So you see that the overnight rate came down in 3 steps very quickly as the pandemic began. And now they're holding that rate at the effective lower bound. Now, that doesn't mean, though, that all interest rates will remain stable. As I mentioned earlier, that with the news of the vaccine, we've seen a big rally in the stock market and a sell-off in fixed income assets, bonds, which means higher interest rates. So the 5-year yield in Canada of Government of Canada bonds has edged up from 31 basis points this year, a low this year, to currently around just shy of 50 basis points. But what the Bank of Canada is doing in order to temper any rise in interest rates is they're committed to buying a longer dated Government of Canada bonds. So they're in the Government of Canada bond market every week buying at least $4 billion worth of Canada bonds. Now, they reduced that weekly amount at their last meeting at the end of October, but not because they didn't want to support the level of interest rates at very low levels, but just because the other kind of quantitative easing wasn't necessary anymore.
Yeah.
But there's a limit to how much of this they can do because they already own 40% of the Government of Canada bond market, which is without precedent in any other country in the world.
So let's go back to, because I think it's important for those that are listening and have mortgages to understand what it means that the target rate is at 0.25%. So if you have a mortgage that's a variable rate mortgage or a HELOC, then your mortgage rate would be tied into that. Now, they did say that, until the economic slack is absorbed, that the 2% inflation and the 2% inflation target is sustainably reached, then that rate will stay at 0.25%, and they're estimating that'll be until 2023. So if you have a variable rate mortgage or a HELOC, that means your rate will probably be the same until then. Now, you may be listening and say, well, Eddie, I have a fixed mortgage rate and my mortgage rate is maybe above 3% or even above 2%. So how will that change? Well, it won't. If you're fixed, then your rate will stay at that rate until your term has expired. So if you want a mortgage broker to look at your rate, look at your term, and maybe give you some advice if you should break your mortgage or go into a lower mortgage rate, or maybe even go into a variable rate, then give them a call or go on our website, www.dominionlending.ca, and choose a mortgage professional in your area, and they can answer all those questions. They can let you know if it's worth it for you to break your mortgage or give you the advice of what to do with that rate. So really important to understand the variable rate is tied into that rate. And then if you're a fixed rate, then it's tied into bonds. And Sherry talked a little bit about the government buying $4 billion a week. That came down from $5 billion a week and will continue to do so. And now they own, you said 40%, Sherry, is that right?
Right.
40%.
Right. There's a chart on that.
Yeah. So that keeps those fixed rates low. is there a threshold where the government says, okay, we can't own more than 40 or 50 or 60%. We don't want to own 100%.
Yes.
Is there, yeah, you
Yes.
talked about maybe stopping. Maybe you can give us some ideas of what that means, like as the government is buying these bonds, and is there a threshold?
Yeah, right now they own, I misspoke, it's not 40%. They own a third of all outstanding Government of Canada bonds, which is huge. They had to move from buying off the market bonds and into the actual bond sales, buying the new benchmark bonds, because there just aren't enough bonds. As I said, our debt levels have been low for years. So Governor Macklem of the Bank of Canada has said that there is roughly 50% would be about the max you would want to see the Bank of Canada own. So this can't go on forever. And really what it's doing is it's monetizing the debt. So we can run budget deficits. There's no trouble getting those deficits financed because the Bank of Canada is buying so much of it, and there is demand for AAA credit Government of Canada bonds, even though interest rates are very low.
Mm-hmm.
But you wouldn't want to see this go on indefinitely.
Right.
And so the good news is that the slack that is in the economy may well decline before 2023. And that's, again, an issue with mortgage financing, fixed versus variable.
Right.
There are no guarantees, right? There's no guarantee that mortgage rates won't rise before 2023. And there's very little likelihood that the downside on mortgage rates is substantial, given that we're already at record lows.
Yeah, you hear, and just in the news recently, you heard about a sub 1% mortgage rate. So, looking at those rates going even lower is hard to fathom. But then again, I thought they wouldn't go lower than 2%. But you made it clear that negative rates are just not in the cards. It's something that Canada won't enter. I just wanted to get your advice on that. So you said something very, very key. Record low rates. Looking at your mortgage, your financing, looking, at if you own a home or you want to buy a home, it is a great time to borrow because rates are so low. But I just want to get your advice on negative rates one more time. I know we've talked about it in the past, but is that possible that we could enter into a negative rate environment?
Not in Canada, not in the United States. And the reason is because both central banks are in agreement that it would be very disruptive for the banking system. And one of the great characteristics of our financial market in Canada is that we have such a rock solid banking system. And indeed, though there's competition between the banks are very clearly working together at the behest of the federal government and the Bank of Canada and the regulators to assure that we get through this pandemic period with as little damage as possible. The major deferrals by banks and non-bank lenders has been an important part of that. Also, some of the new programs that have been initiated for business allows these businesses to borrow money guaranteed by the Government of Canada through the banks. Right. So the banks are a conduit now for fiscal stimulus. And so the last thing you want to do is cause serious disruption in our banking system. Sure. And the economy is going to come back. Let me just tell you a couple of reasons I'm confident about that. Even with pandemic and even with the substantial slowdown in overall economic activity, we have seen personal income growth actually rising. So yes, it is true that many people are still unemployed, and many are working less than full-time involuntarily. But thanks to the government income supports, personal income has been rising. In addition, the savings rate among consumers has skyrocketed. So, and it's not just because people have deferred their mortgages. It is also because they have cut back on credit card finance spending. Mm-hmm. And so, and let's face it, if you're not going to work, you don't have to buy a lot of new clothes. And we're not seeing purchases of major consumer durables other than automobiles. And we're not seeing a big increase in delinquency rates, at least not yet. Mm-hmm. And so what I believe is that once there is an all systems go signal, maybe not till the end of next year, but once we have effectively conquered COVID-19, I think it's going to be the economic equivalent of the coming down of the Berlin Wall, only for all of the world. I mean, people will be dancing in the street. You know, we're going to all have parties to celebrate all our lost birthdays and Christmases and Halloweens and, you know, everything. Yeah. People are going to travel again. Now, that's not to say we're going to return to the way everything was. I think that business travel will never return to the levels that we saw in the past, because we've gotten very good at communicating with one another, just as we are right now. And many, many sectors that were on the road to digitization are very much now further along. And so I gave a talk earlier this week with Victor Dodak, the CEO of CIBC. Yeah. And he was saying that 97.5% of all their banking transactions now are done either at the ATM or online. Yeah. And that isn't going back. That's not going to change.
Yeah, yeah. And for those that are looking for a mortgage transaction, you know, I think about 100% of mortgage transactions through this pandemic, through brokers, have been online via Zoom or e-signatures. There is the ability to do a mortgage transaction from end to end without going and seeing anyone. So if you're looking for that mortgage refinance or that purchase on an end-to-end safe distance, we can do that here at DLC with one of our mortgage professionals. We do have a question for you, Sherry. And by the way, if you have any questions, please do ask them right in the chat of Facebook. What does Sherry expect the tie-in with U.S. bonds to be, and when?
Well, what happens in the marketplace is that the Government of Canada bond market often trades with a very high correlation to the U.S. bond market. And that's true not just for our bonds, but for many bond markets around the world, but especially for Canada, because we are still so tied economically to the United States. So when the U.S. yields began to rise, our yields rose as well. And the other thing it's really interesting is that I haven't mentioned yet is the Canadian dollar is at a two-year high. Canadian dollar, the last I looked, was roughly 78 cents US. And that is largely a reflection of the generalized weakness in the US dollar. In other words, the US dollar has fallen vis-a-vis the euro, the yen, etc. So it's not so much Canada. But that factor is another reason why the Bank of Canada wants to maintain significant monetary support, is because a stronger currency reduces our economic activity, because our exports are are more expensive. It's great for Canadians domestically because we do import so much of our economy. But in any event, those bond markets are very closely linked, always have been.
Mm-hmm.
So that's why oftentimes it's US economic data that dominate movements in interest rates in Canada, not so much the Canadian data.
Okay. Thanks for that question. So let's talk about housing, and we know you've mentioned that interest rates are going to stay low for a long time. Borrowing is cheap now more than any other time. What about housing? Where do you see that going, Sherry? And the price of houses, especially single houses, homes, have skyrocketed. They continue to be an exit from the downtown cores of these cities and condos into the suburbs and single family homes, only because they want more space. They want that home office, etc. Where do you see that trend? Do you see that continuing, and why?
Yes, and there's another factor that's been, we've seen as people have stayed home, many people working from home now, people have reassessed what their housing needs and wants are. The other thing is this remote work, though many people will go back to the office at some point, it's unlikely that they will work 100% of the time at the office in the future for a lot of reasons. Mm-hmm. And many businesses have already announced that those who want to remain at home can remain at home. And so as a result of all of that, there's been a rethink in terms of where you need to live. And if your commute is not a daily one, then obviously it makes sense to consider satellite communities, suburbs or exurbs. And that's where we've seen the biggest increase in prices. Mm-hmm. And so that's a factor. People have been moving out of condos into larger space, again, because of the pandemic. And what we've also seen on the negative side is that thanks to the border closing, the immigration numbers in Canada have plummeted, and rents themselves have declined sharply. And that has meant that those people who were investing in condos for rent, some of them are rethinking whether or not they want to continue to own. We've seen that the new supply of new listings in the smaller rental condo space has increased sharply. In addition, in the new construction, many people who signed up for an investment property have begun to think, as they are coming onto the market, that maybe they don't really want this anymore because rents are not covering the carrying cost of the property. So that's where there's weakness, softness, especially in the Toronto region, but it's also beginning in Montreal and Vancouver, other parts of the country.
Yeah, I saw a tweet yesterday, I believe, where they said out of all the listings in Toronto, so this is Toronto proper, there was only 60 homes under $800,000 for sale. So that's just showing that the affordability prices are getting more difficult. But the good news is the condo is becoming more of an entry-level home. So there is a silver lining. You don't want to see anybody get hurt, obviously. But for those first-time home buyers, the younger buyers, we know that the millennial buyers are going to be a big part of purchasing power in the next 5 years. To have that entry-level affordable dwelling is really important. And also with rents. And if you're renting a little bit cheaper, then that housing sustainability goes longer. Immigration.
The other thing is that the government here has targeted huge numbers of immigrants for 2021 and 2022, right. Over 400,000 new residents in Canada. And so that will boost rents. And we're also seeing that the pandemic winds down. There's no question that the tourism business will begin to pick up again. And so much of the short-term rental supply had been with Airbnbs that have been vacant. So, you know, where the owners are, many of them are trying to sell, that factor will come back in as a net positive. So, but you know, all of this takes time, and I think that 2021 is going to be a major transition year. It's not going to be booming economic growth, but it will transition into what I think will be 2023 will be a very strong expansion year.
Yeah, before I get to, got a couple questions for you, Sherry, before I get to them. If you're looking at your investment and you want to look at a mortgage or maybe get some advice on what you should do, please reach out to one of our mortgage broker professionals. They can help you analyze and assess where you're at. And here's the good news. I mean, with rates so low, it's almost like a forced savings. You're putting so much of your payment towards principal. You know, you have to consider that as well. So I understand that affordability may be a factor. Yes, you're going to get less rent, but if you can make it work, it could work out in the long run for you. So let's get to our questions here. Our first question is from Jason. Thank you, Jason. Do you think shopping and dining will return to normal, or will the delivery of the curbside pickup become a major part of the world moving forward? Jason, I hope not, man. I'm dying to go to my favorite restaurants, and we're trying to support them in our area, but I miss just sitting there and getting served, and that is huge for me, and I'm sure a lot of people. What are your thoughts?
Well, I think both, you know, I mean, I actually have enjoyed being able to get a restaurant quality meal delivered at home too.
Yeah, sure.
I've never used home delivery services for meals before this, and I know I'll continue to do it sometimes. Yes, for sure, restaurants, you know, dining out of the house will come back, but you know, it is going to change. There's no question. There are too many smaller businesses that just have not been able to make it. Yeah. And it's a very costly endeavor. I think that commercial real estate space is going to see also a decline in the number of rents. Even in the most expensive parts of this city, big businesses are closing up because they can't afford the rent. I mean, just one example, the Gap at the corner of Bloor and Bay is shutting down. There only will be one Gap store in all of Toronto, and that will be at the Eaton Centre. And they said that the Bloor Street rents are just too high.
Yeah.
And in addition, Banana Republic is shutting down on Bloor Street, and so is J. Crew. So
I think I read as well. HBC Hudson's Bay Company is looking for some relief, and they may be shutting stores too. So it's not only the small businesses, but the big ones are getting hurt as well. And man, I hope this all comes to an end soon. We got another question here around Alberta. How do you think Alberta fare post-pandemic? So Alberta, I saw oil prices, they keep rising, which is great, and obviously that's a big part of our economy. I think the oil and gas industry, something like 500,000 jobs are within that industry in Canada, so very important to us. How do you think it's going to fare post-pandemic?
Well, you know, Alberta has been hit hard since the middle of 2014 with the decline in oil prices. And let's face it, the world is going green, and necessarily so. And so energy companies, in order to to continue to be profitable have to change their business model. And they are. They absolutely are, in terms of greener energy. But that's a factor, and that part isn't going to change. When we start to see significant travel by air, that'll be another boost to oil prices. But it's very important for Alberta that they continue to diversify their economy. And there is plenty that is going to be hugely, hugely profitable. I mean, there are so many winners from this pandemic. I hate to put it that way, but there's just been so much innovation, and all of that innovation is ripe for development. And Canada has an educated workforce, a very stable workforce. Every province in this country should be working with their universities to attract businesses and to give these high-paying jobs to Canadian talent.
Yeah, and one thing I can tell you, Jason, is Albertans are hardworking people and very resilient. So I think Alberta will be fine. They'll just have to find their niche, and oil and gas will always be around. So that'll be a big part of our economy. But I think there's others that, as Sherry says, that need a little bit of attention, and I think Alberta will be fine. First-time homebuyer question for us, I'd say. Will the first-time homebuyer incentive drive up home prices? Well, that's an interesting one.
It hardly, I mean, the original one that was introduced, they got far, far less take-up than what they had.
Oh, God. Yeah.
It kind of bombed. And I think that people generally don't want to co-own their home with CMHC. In other words, they don't want to share the equity in their home. Now, they've made it more attractive for the high price markets in our country, and that would be especially Toronto, GTA, and GVA, by raising the income bound and by improving the price limit. But I think it's still going to be a relatively minor factor in the marketplace. Yeah,
it never really got a good take up in the beginning, and it continues to have challenges. But the interest rates are a good incentive on its own. I know that prices can be high, but like I said, there is many entry-level homes that are affordable, especially in the condo area. And if you're looking for a pre-approval, you can absolutely go to our website, or you can use our app. Download our app. It's the MMT app from Apple or Google Play, and it can give you a quick pre-qualification in under 60 seconds with 10 or less questions. This is a great way to start and enter into the home purchasing as a first-time home buyer, and you can download that right at dominionlending.ca or from your phone and get yourself pre-qualified. Now, as a first-time home buyer, there's lots of challenges with prices. Is there anything else that you see on the horizon that could come out with first-time home buyers? I know the RSP still exists. Is there anything else that you can see as an incentive?
Well, long ago, it seems like long ago, the regulators and the Bank of Canada told us that they were going to change the qualifying rate, which is currently at around 4.79%, that they were going to use instead the average contract rate as the base level qualifying rate, and you'd have to qualify at 200 basis points above that. So that would be very helpful in terms of qualifying. Now once COVID hit, they just put that on the back burner, and it appears to remain on the back burner for now. But there's once we get through 2021 and we get to reassess where we're going, I think that there could be some significant pressure on the regulators to take another look at that and to provide some reduction in the qualifying rate.
Yeah, and price ceilings as well is a little bit of an obstacle with $1 million. Hate to say it, most of these metropolis now, $1 million is really not getting you much, and so hopefully they'll be looking at that. I think you're right. Once the pandemic is over, they want to continue on stimulating housing, because housing is a big part of GDP. Maybe you can tell us a little bit about that, Sherry, and housing has been sort of the strength through this pandemic, and
absolutely.
Maybe you can tell us, give us your, why do you think that is? Again, going back to March, as any good business, we wanted to prepare ourselves just in case, but it was the opposite. I mean, housing has definitely thrived through this pandemic. Maybe you can give us some insights on your thoughts around that.
Well, for one thing, if we hadn't had a pandemic, remember, we were going into the spring housing market expecting a blockbuster housing market. So there was all the signs were very positive to begin with. Then it stalled for a couple months because of the lockdown, but bounced back very quickly and has remained very strong. And again, mainly because we're all spending more time at home, and the economics of where you live has shifted for those who can work remotely, and more of us will be working remotely, at least part-time. There is no longer the need to deal with public transportation, worry about how long your commute will be. It's just not as big a factor. So that's why we're seeing lots of activity in cottage country all across Canada, as well as in the satellite neighborhoods, satellite regions. And it just makes sense.
Peter, hey, thanks for that, Peter. Yeah, you're absolutely right. I won't get you a mansion, but I mean, everything's relative, right? I'm sure Winnipeg is thriving. I know that you're doing very well there, and I definitely think you're right. But you can definitely see that affordability is affected everywhere. And I wanted to talk. There's a question about condos and the popularity as well as detached homes. There it is. With so many condos available in Toronto, do you feel the price of detached homes will be negatively affected? I know that I read somewhere that 25,000 new condos are coming into the market in Toronto in the next 2 years. Wow, that's a lot. And again, with immigration and the students coming back, I think the number of students that rent condos downtown is astronomical, and that hasn't happened really through this pandemic. But the question here is, do you feel the price of detached houses will be negatively affected? What are your thoughts?
Well, I mean, at the margin, a small house versus a condo, there might be some spillover effects. But let's face it, a detached house is a very different animal than a condominium, and it attracts a very different kind of buyer. Right. So most people who have moved over this period from condos to the single family home have done so because they want not just more space, but more distance from their neighbors. They want a backyard. They want a place to raise children. Even older people, the boomers who had moved into condos, I've heard anecdotally that many have moved to small homes, and further away. That's why, cottage country has become very popular. Because again, they just don't want all these touch points of all of these other people around. And it makes sense.
Yeah, when the vibe comes back to these metropolises, when the vibe comes back to these cities like Montreal, Edmonton, Vancouver, Toronto, you name it, it's going to change the landscape again. I think that's what people are missing. You live in a condo it's almost like a hotel room for many people, because they're out with their colleagues after work, having that coffee or drink, or having dinner, or going to the theater or that sports event, and then they go back to the condo, go to sleep, and do it all over again. So I think that's all going to return back to the cities once this pandemic's over, and condos will be fine. I really believe that. We have a question around renovation and government help. So do you feel the government will provide incentives to renovate your home? So we know that there's a tax incentive as you work from your home. So if you have an office at home, there is a tax break that you can apply for. What about an incentive to renovate your home?
Well, they are incentivizing a renovation that would improve the energy efficiency in your home. Mm-hmm. And let's face it, if you are going to renovate, chances are you'll do it in a way that you'll have more energy efficient windows, or, I don't know how you where you draw the line on what's energy efficient versus what isn't. But if you replace all your appliances with more energy efficient appliances, you probably would qualify for that incentive.
Yeah. There's you can go to the sites and you can just Google incentives for renovations. There's all kinds of information there, for sure. But I do think that more and more people that are going to be working from home and are in need of renovations. These renovations aren't cheap, for sure. If you have equity in your home, and refinancing that home with these low record interest rates is a good idea. And to get in touch with your mortgage broker and have a conversation around that is really important. And maybe Sherry, before we get to the next question, maybe you can tell us a little bit about your thoughts around using a mortgage broker. I know that years ago, it didn't really cross your mind because you came from a bank sort of background, but when you came into our industry, you really realized quickly, the benefits of using a mortgage broker. Maybe you can tell us, maybe take a minute or two and tell us where you see the advantages of using a mortgage broker.
Well, let's face it, if you borrow from a bank, you're basically talking to one lender and there's no competition. So you're going to be offered their product, and it may or may not be the ideal product. And why not get the full array of possibilities? Buying a home is not a do-it-yourself project, and the financial end of it especially is very complex, and it's much more than just what is the actual mortgage rate. There are characteristics of mortgages that vary widely. And so working with a trained, accredited mortgage professional who has hundreds of lenders at their fingertips as opposed to just one just makes all the sense in the world. And not only that, but it doesn't cost you anything to do that. So why not indeed speak to someone who will deal with you individually? It's not a cookie cutter business. What's right for one is not right for all. And they can help you make those kinds of very important decisions and decisions around your whole financial portfolio, as opposed to just, a cookie cutter mortgage.
Yeah, no, that's very true. And these mortgage brokers have access to, the big banks in the country like Bank of Nova Scotia and TD Bank. So there is a lot of options for you. And I like how you put it, there is no cookie cutter. There's options for you outside of just one monoline decision. And these mortgage brokers can shop the best product for you. And chances are, by using a mortgage broker, you're going to get a lower rate. So again, visit www.dominionlending.ca and find a mortgage professional near you, and they can take you through the steps of the mortgage application. Couple questions here. One on small business. With a small business getting really affected during this pandemic, will commercial properties take a massive hit in these major cities? So there's different asset classes when it comes to commercial.
Right.
Warehousing seems to be, and we have a commercial division here at DLC. So we are in touch with what's happening, and warehousing is huge. That obviously, with people ordering online, they need to put these items in places. Warehousing is huge, and the other end of the spectrum is retail, and so commercial plazas and retail stores are not doing that well. But it all depends on the asset class. But I'll let you chime in as well, Sherry.
Yeah, and office space as well is certainly impacted by all of this in both positive and negative ways. In order to appropriately distance, you need to spread people out, and yet at the same time, many workers are going to continue to work from home. So industrial has actually done pretty well during this period because it's the goods producing industries that have been able to maintain their activity, as opposed to the service industries that have been disrupted so much. But it's, I think that the whole concept of retail is in the midst of enormous change. And people want options, and the digitized buying, at least, or even the ability to just look online to see what's available. All of that is essential, and small businesses are absolutely have to be at the forefront of that.
Yeah, absolutely. A question about 30-year AMs for you. Thanks, Michelle. Do you see amortizations on mortgages going back out 30 years for insured mortgages, and insurers reintroducing 85% refinance again in the future? Man, those are good questions, because I think those questions have been asked.
What about 40-year amortization?
I remember those. Yeah.
Not when Evan Siddall is president of CMHC, but his term is almost up. I mean, there's been throughout this period still the concern by the policymakers that people are too indebted. So at this stage, they're not going to do anything to improve the amortization, or anything that's going to lead to a bigger surge in mortgage lending, because they still believe that the consumer is overly indebted. So I don't think that's in the cards right now. In the future, yeah, sure, because it just makes sense. It's U.S. has had 30-year amortization forever. Now, the U.S. did have a huge financial crisis around housing and a housing bubble, but not because of the amortization rate, but because they were making loans to people with no income, no assets, no documentation, and no money down, which isn't going to happen in Canada. But right now, the politics of it is just not there.
Yeah, absolutely. And I think we have one more question, and then we're going to wrap up, Sherry. But I think that when it comes down to it, the government's going to do what they can to keep the economy going and stimulus going. If they have to do a change in refinance or amortization, they will. But right now, it's, as you said, they're keeping debt in check, keeping prices in check, and that wouldn't help. Either of those changes wouldn't help either of those issues. So Marco, hey Marco, regarding renovations, additions, garden suites, etc., do you believe more 55 plus Canadians will tap into reverse mortgages, and do you believe that the reverse mortgage providers will offer more attractive rates than those currently available? So what do you think of those reverse mortgages? They're they're fantastic. I mean, there's never been a bigger sort of attention to those reverse mortgages. We do have them available here at DLC. So if you're looking for more information about reverse mortgages, or you're looking to take on a reverse mortgage, you can do that through one of our mortgage professionals. They're all licensed and certified to do that on the reverse mortgage. But what are your thoughts around that? Is that being more and more sought after?
Well, yes, as the population ages, there are many people who want to get the equity or as much of their equity as possible out of their home for whatever reasons. And so there's demand and there's more competition on that front. And there's, there have been changes in the proportion of the equity that's available. And so I think just like everything else, we will see increasing competition put more pressure in favor of the consumer in that space.
Yeah, no, absolutely. Well, we went over time, Sherry, so I am going to wrap up. First and foremost, I want to thank everybody for supporting In Conversation with Sherry Cooper throughout the year. It's been a fantastic run, and we really enjoyed coming on this forum and informing all of you. And thank you for all your questions and follow-up. To all the DLC mortgage brokers and agents across the country, thank you. It's been a very challenging year. You really stepped up. You made us proud. I want to thank you for everything you've done, especially throughout this pandemic. You are heroes to me and to many, and please try to enjoy the holidays coming up. It's going to be a different holiday season for many of us, but looking forward to getting back to normal soon. And to you, Sherry Cooper, thanks for everything you do. You represent DLC so well. And I know that you're sought after by so many medium forums, and you do such a great job for not only DLC, but for our industry. So thank you for everything you do. And I hope you enjoy your holidays with Peter coming up. And yeah, thank you. Do you want to say anything last minute before we sign off?
Well, happy holidays, everybody, and happy New Year. Next time I see you, it will be 2021, and goodbye 2020.
Absolutely.
Not enough of it.
We will continue this In Conversation with Sherry Cooper next year, so stay tuned for that schedule. Until then, as Sherry said, bye-bye 2020 and welcoming 2021. Take care, everyone.